Good afternoon. This is Jim Barlow with OakTree Strategic Leverage. We're going to talk about the 4 questions that could change the way you think about retirement using the inversion wealth framework that we put together to rethink risk, taxes, leverage, and protection. I'm sure you've heard of paradigms. A paradigm is a way of thinking about or viewing the world. A paradigm is like the lens on a pair of glasses. If you put on red glasses, everything looks red. Today, I'm going to invite you to try on a different pair of glasses in the insurance and investment world. Kevin Worthen said, if the lenses are accurate, the paradigm enhances our understanding. If they're distorted, we sometimes make mistakes. The greatest financial mistakes aren't usually caused by poor decisions. They're often the result of logical decisions made within an incomplete paradigm. So we want to make sure we have the right paradigm. Many people see life insurance through one lens as a death benefit, a policy that pays when someone dies. Institutional investors often see it through an entirely different lens as a financial asset that can provide tax advantages, leverage, liquidity, legacy planning. Sometimes the greatest opportunities isn't changing the asset, it's changing the lens, the paradigm. Let me introduce you our inversion thinking framework, a different way to think about success. Most people ask, how do I win? What investments should I buy? How can I learn? How I misspelled that. Oh, I guess it's got so many dots in there. How can I earn higher returns? What strategy will outperform? How do I get ahead faster? The focus is on achieving success, but inversion thinking asks a different question. Instead of asking, how do I win? Ask, how can I fail? And then avoid those things. That's inversion thinking. Charlie Munger of Berkshire Hathaway fame said, all I want to know is where I'm going to die, so I'll never go there. Well, it's his funny way to say inversion thinking. Avoiding stupidity, avoiding the mistakes is often easier than achieving brilliance. Traditional thinking versus inversion thinking. Traditional thinking, we look for success. We seek opportunities. We pursue gains. We hope for good outcomes. We focus on returns. But inversion thinking, we start with where could we fail? Identifying the risk, avoid the losses, design for good outcomes, focus on the structure. Why do retirement plans fail? Most retirement failures are not caused by poor returns, they're caused by early losses, emotional decisions, unprotected leverage, loss of timing control, taxes, and inflation. If we can avoid these, then success is going to become a lot more likely. The inversion wealth framework is we look for these inversion places, where areas where we could lose. Then we build a structure that is in line with the inversion. Then we use leverage because we've protected the structure. and then let patience do its thing. 4 steps. Identify the risk, build the right structure, apply leverage carefully, allow time to work. Here's our diagram of it. Inversion, avoid ruin. Structure, the system design. Leverage, multiplication. Then patience, letting it compound. Step 1, inversion. What could derail this plan? Ask, what could go wrong? What could permanently impair wealth? What could force bad decisions? What could prevent compounding? Step 2, structure. Structure determines the outcome. A strong structure may include tax efficiency, liquidity, flexibility, protection, proper ownership, risk management. Returns matters. Yes, I do. I understand that. But structure matters more. Then leverage. Not all leverage is equal. There's dangerous leverage, margin calls if you have a stock account with margin options you're doing, personal guarantees if you have personal guarantees you've made, outside collateral, forced decision. But control leverage is long term for sure, non-callable, structured, institutional. Then patience. Time is the ultimate wealth multiplier. I know we all like to get rich quick, but it's not really the way to do it. Compounding requires time, discipline, consistency, a structure strong enough to survive the different economies. The goal, you don't have to be brilliant. The goal is to stay in the game. The core principles, avoid ruin first. Success is often less about finding extraordinary opportunities and more about avoiding predictable mistakes. Extraordinary outcomes are frequently the result of extraordinary structure consistently applied by ordinary people. Inversion, structure, leverage, and patience. A little more on structure. This is important. Most people focus on the investment. Successful outcomes often depends on the structure. In terms of risk, taxes, liquidity, leverage, this is all important. Results are visible, but structure sometimes is invisible. Yet structure determines results. Just an example, In-N-Out hamburgers. Ordinary people, really, extraordinary consistency. Every burger is remarkably similar, not because the employees are extraordinary, but because the structure is extraordinary. The formula, the inputs, the process, the training, the accountability, the culture, the consistency. I'm amazed with the 2 papers that wrap around and just perfectly exactly the same from time to time. When the structure is right, ordinary people can produce extraordinary results. The In-N-Out employees repeatedly. This principle extends beyond hamburgers. Great businesses, strong families, successful retirement plans, faithful discipleship all rely on structure. Again, outcomes are visible. Structure is what creates them. Traditional thinking, we pick an investment. We chase returns. We react to the market. Structural thinking, we build a framework as controls. We control the risk. We control the taxes. We create flexibility. We let compounding work for us. We don't begin by asking what investment should I buy. Sorry. We begin by asking what structure helps me avoid losing. The greatest financial breakthroughs are often come not from finding a better investment, but from discovering a better structure. The 4 questions. Question 1. What if you could participate in market gains without exposing your retirement assets to market losses? Gains and no losses. Oh, I'd love that. Would you? Retirement changes everything. You're no longer accumulating, you're withdrawing. Losses are permanent, not temporary when you're taking money out. Sequence risk moves from hypothetical to lethal. Timing matters more than average returns. Income depends on the structure, not the markets. In retirement, you don't get paid to be patient. I want to show you sequence risk. Let's say we have 2 retirees experience the same average return. It didn't go very exciting here, a 0 return over 5 years, but in different order. Starting with a portfolio of $1 million, withdrawing $50,000 a year. So client A, his first year had a 20% return, second year 10%, third year 0, fourth year negative 10, and the fifth year negative 20. Notice client B is exactly the same numbers, just reversed, flip-flopped. So we have the negative 20 first. Let's see how they performance compares. Here's the first fellow. He had 20% return, then he pulled out 50,000. 10% pulled out 50, 0. So he ends the end of 5 years at 748, 800 because of the 0 return. Didn't really lose it much. Just basically didn't cover his 50,000. But client B, he's going down from day 1. And so at the end of 5 years, he has 511,000. A has 748,000. Wow. That's 46% more. This is sequence risk. In retirement, you've got to protect yourself from sequence risk. It's lethal, as you can see. This is 0% 5 years. Avoiding ruin matters more than chasing returns. Great investors survive. A different approach. We use a cash value life insurance policy. We use index interest crediting strategies with potential market-linked growth, but 0 downside. There's going to be no negative years. No negative years. 0 is the worst year you can have. No direct market investments. Let me show you how we do this. How indexing works in an index universal life. Most of the premium is allocated to high-grade bonds. This is the protection part, with a smaller portion used to buy index-linked options, the growth part. So let's say you put $1,000 of excess money into a cash index universal life policy. 950 is going to go into bonds that in 1 year will grow back to your $1,000. Then the excess from the 950, the $950 are going to put into options linked to an index. If this index ends up negative, this option ends up at 0. But at 1 year, your $1,000 of bonds is back to $1,000. We can protect the principal with this strategy. Protection first, no downside. Growth is second, and that sequencing, the bad sequencing is covered, and what this sequencing is a structure transformative. It's going to make amazing amount for you as a retirement person. Let me show you. There's a lot of fine print, but this shows you some of the indexes with Allianz. Just chose one company, but oh, I've got my bar at the bottom. Let me move it. Oops. Get myself back to. Well, the standard index, way down the bottom, the Stanford 500 index, point to point. If you invest this approach in the index universal life, you have a cap product. See that 12.25? And so that's what the options are able to buy with that money available. And so there's the returns over 5, 10, 15, 20, 25 years, 9, 9, 8, 8.44, 7.69. No downside, but it's also capped on the upside. Then they have some other approaches. This is really a lot of complex stuff, but let me just go the third section down, called the classic index allocation 1% fixed rate bonus. So they have the Bloomberg in the middle and the PIMCO are volatility controlled funds. And notice they don't have a cap rate, but they have a participation rate. 190% or 185%. More conservative funds, but because they're more conservative, we can buy more of the market in this fund to get 190 or 185%. And notice returns are not bad, better than the SP 500, really. Then they recently come out with blended futures indexes. Don't have 100% participation, but it doesn't have a cap. And they're looking nice in their world. And this classic index with Allianz is giving you, on whatever that return is, a 1% fixed rate bonus. You can go with a 15% bonus, or you can actually go with a 40% bonus. But I'm not going to explain those today. We'll leave that for a one-on-one. Okay. So question number one, what if we could participate in market gains without exposing your retirement assets to market loss? Well, we can. We avoid market loss years and we participate in market. Number two, what if your growth could accumulate tax advantaged and provide income that may be received income tax free under current tax law? Well, let's cover that. There's three tax buckets. There's taxable, there's tax deferred, and there's tax advantage. Taxable, bank accounts, CDs in the bank, money market account, regular brokerage accounts, individual or joint ownership. You pay some taxes as you go in a taxable account. Then we have tax deferred accounts, traditional IRAs, traditional 401ks, 403bs for school employees and nonprofits. We have simplified employee pensions for self-employed and for small businesses. And deferred annuities. This is deferring taxes to somewhere later. Then there's tax advantage bucket. Roth IRAs, although limited on how much you can put in, You don't get a tax benefit today when you put it in, but it grows and it's going to be tax-free as you pull it out down the road. Same with Roth 401k, limitations on how much, but they are tax-free. Health savings account, back in my Zion's investment days, I did those all the time. Saved us a lot of money because you can use it tax-free. Properly structured cash value life insurance is another tax advantage bucket. There is a retirement trap. Most retirees have substantial assets in tax-deferred accounts. You probably do, who's listening to this webinar today. I did too. I felt I got sucked into this retirement tax trap when it was time to put in my 401k amounts, and I I wanted to save those taxes today. The taxes saving today was a big deal. So I got sucked into the retirement tax trap too. The more people can get into a tax advantage account, I can say from experience, would be the better. Why life insurance receive favorable tax treatment? Life insurance was designed first and foremost provide families with financial protection at death. Because of this unique role in protecting families, the tax code from the beginning of income taxes in 1918 provides favorable treatment during accumulation, distribution, and wealth transfer. In all aspects, it has a tax advantage. The three tax advantages: accumulation is tax deferred, not paying taxes as it grows, but when the owner passes away, that tax deferral becomes tax-free. The whole thing is tax-free. The transfer of death is tax-free. I put a space in the middle because we have accumulation, we have transfer of death, and then we have distribution. Taking money out, you as the owner, the insured, is tax-free through policy loans. You don't have to pay taxes. You're just borrowing from the account, from your policy. One vehicle, tax advantages during life and death. If someone was to cash in a policy before they died, they pulled out a lot of money before, you'd then owe taxes. We call that a policy blowing up. Well, we add a rider to all our Kaizen policies, which prevents a policy with substantial loans from lapsing. So that this policy is going to be in place when the owner passes away. Therefore, it's locking in the tax-free. Why does all this matter? Traditional investing. You're taxed while you're earning it. You're taxed when it's sold. You're taxed when it's distributed. The federal government needs income, and this is their method. It's not what you earn, but it's what you keep after taxes. If you go with Kaizen, it's going to work for you. So question 2, what if growth could accumulate tax advantage? Tax-free, actually. Well, after-tax income matters more than pre-tax. Question 3, what if institutional leverage could potentially increase your retirement income by 50 to 100%? You mean I can almost double my income, maybe at least 50% to 100%? Yes. The wealthy think different about leverage. Banks, their whole premise is on leverage. Corporations use leverage. They all use leverage. The company that doesn't is going to have a takeover involved. Real estate investors always use leverage to buy real estate. Leverage is used a lot in our country. And there's good leverage and there's bad leverage. Let me show you. So bad leverage, a margin call, personal guarantees, outside collateral, forced liquidation, excessive leverage, loss of timing. Leverage becomes dangerous when it creates a possibility of a forced decision at the wrong time. Oops, pushed the wrong button. I think I lost the slide I was looking for. Oh well, we'll skip it for now. Let's introduce to you Kaizen, a structured approach to institutional leverage. The client contributes. There's actually 5 payments, 5 yearly payments or 5 years of monthly payments. Then we do institutional leverage. We use a master trust. We do the borrowing at lowest interest rate, the lowest rate that you're paying possible on borrowing money. It's in a life insurance policy. There's all the structured advantages. Oh, I'm going backwards. Sorry, I'm having a hard time today. With this institutional leverage, we have no margin calls. We have no outside collateral. You're not putting anything up. There's no personal guarantees. We have built this policy so there's nothing like that. There's no obligations on your part. Let me give you a case study. We have a male, age 40, contributing $25,000 per year for 5 years. So his total out of pocket is $125,000. His objective is to get income from 65 to 100, his retirement years. He's excellent health, non-smoker. We're going to use a growth rate of 6.84. This is regulated and stipulated by the National Association of Insurance Commissioners. Insurance is managed, regulated by individual states, the insurance commissioners. And this association has come together, put some rules together, but all the states follow. It's kind of the way to keep it on things. And that's the illustration right there they're allowing at this point. So I used 6.84. Let me show you how things look. For that 40-year-old getting 6.84, we could give him income starting at 65 of 72,000 a year. By the time he hits 100, he would have pulled out 2,592,000 without just 100,000 invested. What if he did this without the borrowing, without the leverage? Same return for sure. Everything's the same, just no borrowed money. Instead of 72,000, you'd have 46,000 income. Instead of pulling out 2,592,000, you'd pull out 1,656,000, almost a million down lower than 72,046. That's quite a sizable income. So that's what leverage does for us. 56% more income, and the investment really didn't change. If you did this in a regular investment account, paid taxes as you go, your income is now down to 26,650. Same return, just a different way. Instead of 72,000 or 46, you're down to 26,000. That Kaizen is 240% more income. 240%. That almost 3 times that amount. The very first policy of Kaizen was issued in 2012, and the owner gave me permission to show the numbers. Her annual statement comes out on June 27th every year. And we're past June 27th of 2026, but the statement they have not shared it with me yet, but I'll update this. So this is actually accurate as of 2025. Notice the average return has been 7.85. Not bad. Looks good. The average interest rate paid on the borrow part is 3.95. Well, that's not very high. That's good. That's what institutional leverage helps people do. And then the spread. The spread is how much you're making on the investments, subtract what you're paying for the borrowed money. And so she has made 3.9% on all her borrowed money from 2012 on. Wow. And after that, I put down the long-term historical returns of the S&P 500 is right about 10%. So, Jim, 10% is higher than 7.85. And I said, yes, that's correct. Remember, this is tax advantage, probably tax-free. So if we do the calculation and just say taxes is costing us 25% total, that means we're getting a return of 7.5 instead of 10% or 7.85. Not bad. Municipal bonds is not a bad way to go for the conservative person. Let's see. One more thing I'd like to point out. NIW, that's the founders of Kaizen. They have looked back to the 1930s and they have seen that there's no 15-year rolling periods of time that the spread has been less than 2%. Long 15 years, you're always making at the lowest nothing less than 2%. In this particular case, they're making 3.95. Maybe in the future they'll make more than that, but there's never been a 15-year period of time with less than 2. That is using other people's money to make money. So question 3. What if institutional leverage could potentially increase your retirement income by 50 to 100%? It does. With Kaizen, you get that 50 to 100% more income. Question 4. What if the same strategy also provided life insurance protection, chronic illness benefits, long-term care benefits, and disability protection? Well, it does. Day one from buying the policy, you got the immediately death benefit. You got all these living benefits, disability, chronic illness, critical illness, terminal illness, long-term care, all these benefits in addition if you're not around. The 4 questions. So, do we get these additional benefits? The retirement strategy designed to address both the opportunity and the protection. How can I recap these? Can I reduce downside risk? Yes. Can I improve tax efficiency, make it tax-free? Yes. Can I use leverage intelligently with no collateral? Yes. Can I protect my family and myself and still have all these retirement benefits? Yes. There is a final question. What if the biggest risk isn't market risk? What if it's market losses, behavioral mistakes, poor structure, taxes, health events, longevity? That's what our inversion wealth framework helps solve and helps you. Most financial plans focus on returns. The best plans focus on outcomes. And that's our presentation for today. Um, if you have questions, there's my phone number, there's my email, my website, and the QR code on the right. That is a landing page with videos on Kaizen, 10 chapters on explaining the details. It's like your Amazon account where you pull it up and get all the answers you want. That's probably the best place to start if you have questions. But I'm here, and I've had fun showing you this presentation today and looking forward to talking to any of you and answering your questions. Have a great day. Bye.